Welcome to the Organized Expat, brought to you by Tytle, the platform for expat taxes. Hi everyone, welcome back to the show. Today we're going to do a country special about Italy, and I think there's so much to tell about Italy and taxes in Italy that we could easily make, I don't know, maybe 5 podcasts about Italy. So for today, we keep it simple. We stay a little bit more at the surface, and then next time we will go into a specific subject. And probably we'll do that 5 times. What do you think, Laurens? I'm here with Laurens, of course, our tax specialist.
Yeah, I would say we can make 5, 6, 7 videos about Italy.
Yeah, probably you could even make 100 podcasts about Italy,
and I said
right?
videos and then podcasts.
Yeah. No, that's true. Italy is, of course, a complicated country when it comes to taxes.
Yeah.
So we'll see how many podcasts we'll make. But this one is a little bit more general. So Italy, what to tell the listeners about taxes in Italy when you come to Italy, when you move to Italy?
Yeah.
First of all, I think we often start with that. That's the tax rates.
Yeah.
Just looking at the tax rates, nothing else.
Exactly.
What stands out? Is it,
right,
let's say, high, low, average? What do you think?
Yeah, so for the income tax rates for employees, I think they're quite average from a European perspective, and also quite simple because Italy only has 3 tax brackets.
Yeah,
23%, 35%, 43%.
You go up to 43%, which strikes me as low.
Exactly, and that's for 50,000 and higher. And it's 43%. So I think that's quite decent indeed for Italy. Then, of course, you have social security contributions as well that you always have to factor in.
Yeah.
But the other day we were talking about Portugal, and then I think we saw 7, 8, or 9 tax brackets. So it's definitely a bit more simple. And also, I would say from 50K onwards, 43% is not very high in Europe.
No.
Most countries will have a top tariff of around 50%.
Yeah. So it's funny, if you just look at the tax brackets, then you could get the probably incorrect impression that taxes are easy in Italy. Huh?
Exactly,
brackets,
which is not the case.
Which is not the case. So they're fooling us there. Okay, 3 brackets. Social security comes on top of that.
Right, exactly. And then you have an employee part, of course, an employer part. So for the employee, it's around 10%. That you have
because social security is, I think, always or nearly always is paid by the employer, partially, and by the employee.
Exactly. Yeah.
And we're now only looking at the employee's part because that's probably most relevant to the listeners.
Right.
So that's at 10%.
Yeah, for employed people, for self-employed people, freelancers, etc. It's a bit more complex. There's not one standard rate, but it's mostly 26%, can go even up to 33%, depending on specifics.
Which is super high.
Which is higher indeed, of course.
Yeah.
But I mean, what we get to speak about later as well is that there's quite a lot of advantages for freelancers as well.
Okay.
So these are the communicating vessels that we
often see.
Mentioned.
Yeah, true. Okay, so as I promised, we'll keep it a little bit more general. So we go through that quite quickly through this intro, and then also perhaps we'll go, because this is an interesting subject, the impatriate regime. So for people coming to Italy, probably that's what they're most interested in. So we could tell a little bit more about it, but all the detail, perhaps that's
I think
really...
we can save the details for another podcast.
Yeah, let's do that.
But maybe already talk a bit about what it is, why it was created and everything, which is
only
of course
the highlights.
Which is of course to counter the brain drain that Italy was suffering from. Also attract foreign talent, of course, boost economic growth.
Many Southern European countries and Eastern European countries suffered from brain drain. People with education degrees, they left the country.
Exactly.
And now they're trying to get those people back.
And that's what they used to have 70 to 90% income tax breaks, which was changed this year to 50% tax breaks.
And by the way, talking about brain drain, I think it was originally only for Italians leaving Italy and coming back. But then that changed at some point, and now it's for everybody coming to Italy. So it doesn't matter whether
Right,
you're
so exactly.
Italian.
I think under EU rules, you cannot discriminate.
Yeah, of course. Yeah.
So I think what you often see in the setup of these kind of expat regimes is that they, for example, say this is for people who they could say you cannot have been an Italian resident 5 years before coming to Italy. So they try to make some wording that to make sure that it's actually Italians that went abroad and came back. And of course, that would also apply for non-Italians.
Because this means that you have to be a resident somewhere else, doesn't matter where, for at least 5 years. Is that the case? I think it's 5 years, because it used to be 3 years and now it's 5 years.
Well, actually, it used to be 2 years, and it's now extended to 3 years.
Okay. Yeah. And then you can come to Italy and take advantage of this regime. And the exemptions that we're looking at are 50%, even 60% if you have a child.
In some cases, indeed, if you have a child under 18. Okay. And then it used to be 70% and 90% for southern regions. But you see that we know that Italy no longer has that distinction between north and south. It's more
country-wide regime.
Exactly.
Now. Yeah. Okay. And there's a lot more to say about that, but we'll save that for another podcast.
Yeah.
But it's an attractive regime because it's 50 or even 60%, which is huge.
Yeah.
And we see many clients approaching us because they moved to Italy. And
last year, of course, a lot of clients when the tax breaks were even higher, but we haven't seen a drop in clients.
It's still very popular.
It's still very popular, yes.
Yeah, and probably also because Portugal abolished its NHR regime, so people are looking for other opportunities.
The new star of Southern Europe, which is Italy.
Okay. So, what else? The neo-domiciled regime. What's that?
Right. So, in a nutshell, that is buying off your tax on foreign income against 100,000 euros.
Yeah.
They're going to change that to 200K. So, I mean,
normal this means that you just pay 100,000 euros and no questions asked.
No questions asked, even no wealth tax asked. So that's 100,000. Will go to 200,000. So this makes sense if your foreign income, let's say investment income, is very high.
Yeah. Probably if you make millions a year.
Exactly. So
then it makes sense.
It's more for the super rich.
Yeah.
If you just casually go to Italy, let's say, I don't think you're going to have to worry too much about it.
No, then this is not, let's say, the most relevant regime. I'm looking at the other things that we would like to discuss. When you come to Italy, I think this one it's relevant also for the general podcast that we're recording right now. 183 days, of course, we all know that that's very often a relevant threshold. If you stay in a country for more than 183 days, then you trigger tax residency there. And in Italy, it's also the same, right? It's a very important threshold there.
Yeah. I think the difference here is that, in most countries, when you hear about those 183 days, from the moment onwards that you register there, you're considered a tax resident. But Italy just considers you a tax resident if you've been in Italy 183 days in the fiscal year, which is the calendar year.
Yeah.
So if you go to Italy on 20 July, for example, you will not have been 183 days in Italy in that year. And you see people playing around with those tax residence rules quite often. If they leave their country in the second half of the year, then go to Italy, then it could be that a few months of the year are not taxed anywhere because you're not a tax resident.
Yeah, that's indeed very strange that Italy still sticks to this calendar year. So if you come to Italy July 2nd, July 20th, in that case, you won't reach a threshold of 183 days, meaning that for the whole calendar year, you're not considered a tax resident. If you come to Italy, let's say in April or in May, and you'll stay until the end of the year and next year. then for that year, you will probably be considered a tax resident for the full year, even for the months that you were not yet in Italy.
Exactly.
Also
and then
for January, February.
And then it will be tricky if, for example, I think you mentioned April, right? April, yeah. So if you leave the Netherlands, for example, in April to go to Italy, then the Netherlands will say you're a tax resident until April.
Exactly.
Italy will say for the whole year. So normally you have a tax treaty then that avoids double taxation, but that's easier said than done. Because you can explain to the Italian tax authorities why your capital gain in February, for example, should not be taxed
in Italy because it was taxed in the Netherlands, and then you're in all kinds of trouble. So planning here is important. So preferably don't go to Italy, don't move to Italy, let's say before July, because if you do so, then you could trigger tax residence for the whole year.
And it will just make things a bit more complicated.
It could make it more complicated.
Of course, if you go on the 1st of January, it's all okay.
Sure. Then it doesn't matter that much. But planning is important here. That's, let's say, the takeaway. Self-employed people, what do you think about the treatment of self-employed people in Italy, tax-wise?
Yeah, again, so you have two regimes in Italy. It basically says that if you earn up to 85K, you get a simplified regime. If you earn more, you get the standard regime in Italy. And that's also what clients often ask us about.
Under 85,000 means simplified regime.
Yeah, exactly.
Meaning?
Meaning a flat 15% tax rate on your income. And then there are some, like a certain percentage of your income is taxable income. It's mostly 78%, but there are some different professions that have a different percentage. There's a table for that. I don't know it top of my head, but let's say if you earn 50,000, for example, then 78% of that 50,000 is taxable. And then you pay a 15% flat tax on that. And there are some other benefits that you don't, you're exempt from charging VAT, for example.
Okay. So here they try to make things simple.
Exactly.
That's good.
And even new businesses could qualify for a 5% rate in the first 5 years. And it's also good to mention, I think, that so there's no time limit to enjoying this regime. It's just make sure that every year you earn less than 85K.
Then you will always...
That 5% flat tax rate is just for the first 5 years. But for the rest, it's not some kind of benefit that expires.
Okay. And if you go over 85,000 per year, then it gets complicated, or not?
Yeah, so it doesn't get complicated. It's just the normal treatment then. So you will have the standard tax rates, the ones that we mentioned at the beginning, 23% until 43%. And then Social Security, of course.
Which can be quite high, the Social Security part.
Exactly. So the taxes get a bit higher then, of course. So that's why, we see a lot of people coming to Tytle with questions about the simplified regime. And sometimes
so if you're, let's say, just around 85,000, then it perhaps makes sense to stay. And that's always, to me, a little bit puzzling that they have those thresholds. Of course, I understand it. At the same time, it could also mean that people are afraid to go, let's say, to run that extra mile because that tips them just over the hill into another regime. And that's always a little bit tricky because it could also be a wrong incentive. It could create wrong incentives. Okay, pensions.
Right. So for pensions, of course, you have these progressive tax rates, the 25 until 43% again. This time you don't pay Social Security contributions because you've done that while you were working.
While the pensions were built up, Social Security has already been paid, so you won't pay that another time when you receive the pensions.
And then, maybe good to mention there's a special 7% flat tax rate on pensions, but that is just for certain villages in the south of Italy. I think to boost a few regions there. So the requirements are quite funny. These are villages with less than 20,000 people, for example, and then some other rules that you need to...
It would also be funny if you live there and then one extra person moves into town and you lose all your benefits.
Exactly.
But so south of Italy, fewer than 20,000 people, then it could trigger, or then you could get a special treatment. Real estate is also something we would like to discuss quickly, maybe, because it's not too complicated.
No, exactly. So this is let's speak about rental income. So the progressive rate is 25 until 43, the standard regime again. But you can choose for something else, which boils down to a 21% flat tax on real estate income, so on rental income, or even 10% if certain conditions are met. So that's like some kind of long-term rental agreement with probably a few extra requirements. So then it could be a 10% flat tax on that even. Yeah.
Okay, great. Wealth tax is also exists in Italy?
It exists, yeah. Real estate outside of Italy, if you're a real estate owner, let's say if you have a house in Spain, the Netherlands, Germany, whatever, there's around 1% tax on that. It used to be 0.7%, but it has been increased in 2024 to around 1%. And then there's a 0.2% tax on financial assets. So let's say bank accounts, stocks, bonds, etc., also held abroad.
It's quite low, the wealth tax, but there are also countries where there's no wealth tax at all.
Yeah, exactly. So you can imagine if, for example, there's 1% on real estate located outside of Italy, you always have a tax treaty, of course. So if you already paid wealth tax in that other country, then that 1%, as in the taxes paid abroad can be offset against that 1%. So it's just to make sure that it's taxed somewhere.
Yeah, and that could be in Italy.
Exactly. So if that other country doesn't have a wealth tax, then you're just going to pay it in Italy. You could argue it's a bit unfair because the real estate is located abroad, and it's a wealth tax.
And that's something that we touch upon quite often in this podcast, that when it comes to real estate taxes, then you always have to look at the country where the real estate is located by default. And you hardly ever see, but here there's an example that other countries are interested, or at least that they start taxing it. But here you see an example of another country, in this case Italy, taxing your real estate, but
well, you can see
but you can offset it.
You can even see it with rental income quite often. That if you have let's say an apartment that you rent out abroad, then you still need to report it because it's worldwide income wherever you live. But then the taxes abroad are sometimes offset against what you paid in the country where you live. But most of the times, countries, what the Netherlands does, for example, often is they have an exemption for rental income abroad because probably has to do with some fairness or compliance.
Yeah, but let's say the right of taxation is in the first place with the country where it's located, and then sometimes also with another country, or there's also a certain taxation rate for another country. The country in this case where you're a tax resident. And if that's Italy, then there could be, let's say, a relevant rule here when it comes to the wealth tax related to real estate. So to conclude, inheritance tax, is that brutal in Italy or not so much? What do you think?
Well, I mean, I think from a European perspective, again, it's not very brutal.
No, I think the Netherlands is brutal, right?
Yeah, I mean, also depends on perspective, of course. I think in the Netherlands, there's a lobby that is calling for a higher inheritance tax rate right now. So it depends on perspective, honestly. But I think, in Italy, for example, for your spouse, it's 4% inheritance tax on assets exceeding 1 million. And then the rates differ a bit for other types.
Okay, so under 1 million, there is no tax, inheritance tax.
That's true.
Okay.
Then siblings, it's 6% tax if it exceeds 100,000. If you have other family members, it's again a 6% tax, but it's the entire value of the inheritance. And if people are unrelated, let's say your neighbor, then it's 8% tax. So
which is not
differs a little. It's
but
still
here
not
again, it's important, I think, to emphasize that the inheritance tax is often determined, nearly always, by the country where the deceased person lived, and not by the country where you, as a heir,
exactly.
live. So it's more. So this is really something that relates to the deceased person. If the person who dies lives in Italy, then this is applicable.
Exactly.
And if you move to Italy and you receive an inheritance from another country, then the Italian rules don't apply.
Yeah, that's true.
Okay. So that was the general overview of Italy, and I think we have enough to talk about left for another podcast or 5 maybe. So thanks for listening, and as always, if you have any questions, remarks, or observations, please reach out to us. And if you want to move to Italy yourself, or you even moved to Italy, or you have a tax question in general, doesn't have to be Italy related, then go to Tytle.io. You will find it in the description, the address, and we'll be very happy to assist you there, of course. So thanks again for listening, and see you next time. Bye-bye.